60 down at the start. That's what the Nifty is giving.
And it's a big down day for our market.
Market continues to slip. We have Nifty sitting with cuts of 250 points.
And that 250-point cut has now become a 300-point cut now on the Nifty, with the sensex lower by 700 points.
By the way, I was checking foreign screens once again. So Europe is still reeling under losses, 1.5%. Futures on Wall Street are down anywhere between 0.8% on the S&P 500, over 1% on NASDAQ. Let's see. There was a pullback, a 100-point pullback, no less, from the lows of the day. So instead of a 300-point cut, the Nifty is now looking at a 200-point cut.
Hello and welcome to Markets Today, the show where we track 6 hours of the day's trading action and 5 headlines. I'm Reema Tendulkar, and these are the headlines for the day. Stock markets decline across the world after the Fitch downgrade. The Sensex drops below 66,000. The Nifty loses over 200 points even after paring some losses in late trade. Ratings agency Fitch downgrades U.S. government credit rating from AAA to AA+. This is the first downgrade by a major firm in over a decade. Fitch flags growing debt burden and cites erosion of governance. U.S. Treasury Secretary Janet Yellen criticizes the move, calling it arbitrary. Ambuja Cement delivers a beat on the top line, aided by solid volumes. Indigo flies high, sees profits come in at over 3,000 crore rupees versus a loss last year. But Godrej Properties disappoints in Q1 with a weak operational performance. Cholamandalam Invest tumbles on a weak Q1. The Thermax gains on strong sequential improvement on all counts. Reddington falls 10% after it fails to meet street estimates, while Strides falls despite a decent Q1. Tata Chemicals loses close to 3% after it cut domestic soda ash prices by 1,800 rupees per ton. Centrum Broking believes the price revision will impact margins, but it will normalize soon. Stock markets around the world declined today, and Dalal Street followed suit despite paring some losses in late trade. The Nifty and the Sensex by the end of it ended with a cut of 1%. 43 out of the Nifty stocks ended with cuts. Banks underperformed the blue chip. The Nifty banking index was down 1.3%. BSE companies erased a market capitalization of over 3 lakh crore rupees. Okay, let's get to the second headline then. Rating agency Fitch has downgraded the U.S. government's long-term credit rating from AAA to AA+ rating, leading to a decline in stock markets around the world. This is the first time in more than a decade that a major firm has downgraded the U.S. government. The last time the U.S. government was downgraded, it was by S&P 500 by S&P way back in 2011. CNBC's Arabelle joins in with the details.
Fitch stripping the United States of its AAA credit rating, downgrading America to AA+. Now, the agency cited what was a steady deterioration in standards of governance over the last 20 years, following the highly fraught bipartisan talks in the month of May, which eventually saw the debt ceiling raised until January 2025. Now, the agency had placed the U.S. on negative watch following the 11th hour deal. Fitch then also flagged a high debt burden, along with an expected mild recession that's set to happen in the fourth quarter. Now, U.S. Treasury Secretary Janet Yellen hit out at the decision, describing it then as, quote, arbitrary and based on outdated data. Reaction to this move then was muted, though, from analysts in particular, with demand for treasuries actually expected to remain strong as a safe haven asset despite this downgrade. A note from Goldman Sachs even noted that the move from Fitch did not reflect any new information and should not have any major impact on markets.
I think from a longer-term perspective, people are going to begin to thinking that they've got to diversify their holdings first away from the U.S., and also into equities, because that's a way to protect them from any deterioration of the currency, the U.S. dollar, or for that matter, any other currency. So I would say this downgrade is going to have a lot of people thinking about diversification, not only away from the U.S. market, but generally speaking, away from their home markets.
What we can clearly see as we come in today in Asia is that the dollar is very stable. We've got a slight back up in the 10-year yield, but there's nothing of great significance there.
Lata now joins in to decode the impact of the Fitch downgrade on Asian markets and what to expect next. Lata.
Well, it has been a very sharp decline that we've seen in currencies. Korean won down over 1%, the ringgit 0.6%, Filipino peso 0.5%, 0.56%, the rupiah again 0.5%, and the Indian rupee was 0.33%, and by close of day it was almost 0.4% that it fell. Now, here's the peculiarity, and this was repeated even previously in 2011, August 5, when the S&P had downgraded the US treasuries. You know, for most other treasuries, for instance, if there is an Indian downgrade or a Pakistan downgrade or Sri Lankan downgrade, that currency falls. In this case, the currency actually appreciated and other currencies measured against the dollar fall. Now, why is this? Because people look at this event as uncertainty over the market. Let me go back to the 2011 August 5th downgrade by S&P. The dollar actually strengthened from 74 on August 5th to about 78 by September 30th of 2011. So one actually saw a flight to safety, as it were. People pulled away from emerging markets not knowing what this event might cause. And you know, when you pull away, you naturally put it back into dollars, the mother country, and that resulted in the strengthening of the dollar. Now, there were two kinds of things which created the uncertainty. One set of people saying that, many funds, pension funds, etc., follow a best of three model. That if already S&P has downgraded the US dollar from AAA to AA+, if one more agency, Fitch, joins in, then the best of three has downgraded, so we have to move away from that asset. It was this worry that made for a lot of this sell-off. But what experts told us is that after the 2011 episode, funds have rewritten the rules to say that this downgrade won't apply to only one category, and that is US Treasuries, and so there may not be a sell-off at all. So this looks like it could be knee-jerk. Now, the other set of people point out that, you know, with two agencies telling the US that your debt is too high, that your fiscal deficit is too irresponsible, and Fitch has used the word lack of governance, poor governance, there could be a moral pressure on the US not to go ballistic with its fiscal deficit. At the moment, there's tight monetary policy but loose fiscal policy in the US. It's possible that they will have to bring it down, and that might be negative for US economy, US stocks, and therefore for the global economy. But a large majority of experts I spoke to think that this is going to be just a passing phase. We are going to accept dollars for the software we sell. The Arab countries will accept only dollars for the crude we buy from them. And where will you put your dollars? You will put it in treasuries. So just a brief knee-jerk reaction.
Lata, thank you very much for putting that in context. Now let's get to the third headline for the day. Ambuja Cement was under pressure despite reporting an all-round beat in the first quarter on a standalone basis. The revenues came in at over 4,700 crore, higher than expectation of 4,400 crore, and this was driven by strong growth in volumes. Nigel is here with the key highlights.
Well, Ambuja Cement's numbers were a little bit better on the top line, while the operational performance was bang in line. On the top line itself, there was a beat of close to 300 crores. That's because they sold volumes which were 500,000 tons in excess of what we were expecting. The EBITDA number as well did get a boost up because of flowing down from the revenue parameter. On the margins front, it was bang in line, and profitability as well more or less in line. Now, to run you through a couple of parameters, despite them selling a higher amount of cement, well, the costs were lower. So power and fuel cost, other expenditure, as well as employee cost, all of them were lower. The management says they continue to focus on operational efficiencies, and they also mentioned that the kiln cost has reduced on a sequential basis as well. The balance sheet remains solid, with them sitting on cash of more than $1.5 billion odd. And the management, in fact, in their commentary, they made that point that the synergies with the Adani Group, they are playing out, and that's what's going to help their EBITDA as well. All in all, a good set of numbers.
Okay, thank you very much for that. Moving on to Godrej Properties, the stock declined 2% on the back of a weak Q1. The company reported a 44% dip in booking value on a quarter-on-quarter basis. Collections too were down 49% again on a quarter-on-quarter basis. Sonal is here with the highlights.
Thank you so much for that. It was a weak operational performance coming in from Godrej Properties, both on a YOY and on a quarter-on-quarter basis. If you look at the bookings of the company, the area sold is down 20% on a YOY basis, 57% on a sequential basis. Their booking value is down 11%, down 44% on a sequential basis to come in at 2254 crore rupees. The collections are up YOY around 26%, but they are down 49% on a sequential basis. The company itself says that it was a muted performance and it was due to some planned launches being delayed in the quarter. They expect improvement to come by from quarter two itself, and they remain on track to meet their full year guidance. What is the full year guidance? They expect to do 14,000 crore rupees in terms of their bookings, collections of around 10,000 crore rupees, and deliveries of around 12.5 million square feet. If you look at the sales breakup as well, it's a decline across geographies, but MMR region continues to be the biggest contributor for them, around 656 crore rupees there, followed by NCR. Bengaluru also has become big at 509 crore rupees, and Pune and others are the other geographies that the company caters to. The balance sheet is a little stretched this time. Their net debt has increased substantially on a quarter-on-quarter and on a YOY basis. The net debt has come in at 5,300 crore rupees versus 3,649 crore rupees, and they've made some provision in their P&L. It's getting flashed at the bottom of your screen. So that is something that impacted their EBITDA this time around as well.
Thank you for that. And staying with earnings, Titan is going to announce its results for the first quarter. The street is expecting a yearly improvement on the revenue and profit front, but margins may see some compression. Mangalam joins in with the expectations.
Well, as always, for Titan, we have a cheat sheet that the company gives in the form of its first quarter preview. And out there, they've said that, the jewelry business has grown by about 21%, and the standalone revenue growth of the company has been around 20% as well. Analysts have plugged those numbers in and estimate an overall revenue growth of around 15% on a standalone basis, a little over 10,300 crores, and EBITDA grows at around 10%. That means margins are stable at around 12.5% versus 13% the same time last year. The net profit, however, grows by about 8.5%. What are the other sectors that are likely to grow? Well, analog watches have seen a growth of 8%, and digital watches have seen also a growth of 84%. And then new divisions, the kinds of fragrance, fashion accessories, and Tanera saris have done even better. So now that we have the numbers, the key thing to watch out for will be what the management has to say for the remainder of this year in terms of demand.
Thank you for that. We'll get into a break. We'll come back with the other headlines. Stay with us. Welcome back. You're watching Markets Today on CNBC-TV18. Today was that kind of a day where everything was red in trade. The markets had a gap down opening, continued to grind lower on the back of the Fitch downgrade of US sovereign credit rating. At one point of time, the Nifty was down nearly 300 points. But in the last 45 minutes of trade, there was an attempt, a feeble attempt. Some recovery at least took place, and the markets by the close of it was down 200 points on the Nifty, ending above that 19,500 mark, with sensex losing more than 700 points, a cut of more than 1%. Banks underperformed today, the Nifty banking index seeing a cut of 1.3%, and in terms of individual losers, it was Hero MotoCorp, Tata Steel, Tata Motors, Bajaj Finserv amongst the top losers, with cuts of close to about 3%. But that's the frontline action. Let's get to the earnings corner, and this is the fourth headline for the day. Cholamandalam investment tumbled 3% on the back of a weak Q1. The net interest margins at 7.3% has come in lower compared to the prior quarter. Asset quality has improved on a quarterly basis. Abhishek joins in with the key highlights.
Well, the earnings were weak and they were expected to be weak, but it is much weaker than the expectations themselves. Talking about the key highlights is that board has approved a QIP of about 4,000 crore. We did highlight in our preview note that, any fundraising plans will be seen very closely. Disbursals momentum was strong at 50% YOY and a decline of 4.8% quarter-on-quarter, which is seasonal in nature. The AUM growth is pretty robust at 41.5% YOY and about 8.8% sequentially. However, what has weighed on the result is that the net interest margin is at 11 quarter low of 7.3% when compared to 7.8% in the previous quarter, and the decline in net interest margin is much higher than what the management had guided earlier to the analyst as well. Asset quality has improved. Gross NPA ratio is at 9 quarter low of 4.3%, and net NPA ratio is at 10 quarter low of about 2.77%. Earlier in the day, we had the management on our channel who did say that, the new businesses will have slightly higher NPAs than the overall NPAs, but it won't be a showstopper for sure. So analysts in their notes have mentioned that the new businesses, which are just 12 months old or about 2 years old, are seeing a gross NPA ratio of 5% when compared to 4.3% that the company has recorded. So in terms of their performance versus our poll, NI is higher than our poll. However, due to provisions being on the higher side, PAT is below our poll. Brokerages, they have a mixed view on the stock. CLSA has downgraded the stock to outperformance from buy recommendation that they had earlier. Across brokerages, you have target price ranging from as low as 1,000 per share to as high as 1,350 per share. Back to you.
Thank you. Let's move on and talk about Thermax. That's one stock which managed to close in the green. This is on the back of a sequential improvement in its Q1 numbers. Consolidated revenues have come in at 1,900 crore, which compares with 1,600 crore in Q4. EBITDA has also improved on a quarter-on-quarter basis. So basically, all the parameters look good on a sequential basis. Vivek is here with the highlights.
Well, amidst the sell-off that we saw in the markets, one capital goods company stood out tall. Thermax is the one that we're talking about. The stock continued to trade in the green despite the fact that we saw significant selling pressure across most segments of the market. What are the reason? The company delivered a stellar set of numbers as far as Q1 was concerned. Revenues went up almost 17% higher, coming in over the 1,933 crore mark. This was on the back of the fact that the company said that it saw improved performance as far as the industrial products and chemical segments was concerned. Coming to the EBITDA, tight cost controls helped the company go ahead and increase the core EBITDA by almost 37.5% to 132 crore. And on the back of that, EBITDA margins to increase by 100 basis points. However, on the bottom line, the company did see a one-time impact of 51 crore. This is on account of an ongoing litigation that the company is facing. And because of that, profitability went up just 1.7% to the 60 crore mark. Order booking for Q1 went up 11%, coming in over 2,567 crore, while order balance or the order book stood at 10,505 crore. Macquarie believes that the strong order inflow momentum that the company sees indicates that the base ordering momentum continues to remain quite strong, and most of the brokerages, in fact, continue to stay quite bullish as far as Thermax is concerned.
Thank you for that. But one stock which didn't have any luck today is Reddington. Reddington ended down 10%, and the big miss in their quarterly numbers was the decline in margins. Margins for Reddington have been steadily declining. In the current quarter, they've come in at 2%, but as you can see, margins for the company were closer to 2.5–3%. So despite a strong top-line growth of 26%, the profits for the company came down by 21%. The company said this is on account of high interest costs, factoring charges, which is on account of the current global situation, the financial conditions, and they expect things will improve in the second half of the year, or at least normalize. The working capital days too shot up to about 40 days, which is higher than the company's comfort level of 28 to 35 days. So that was also an added concern. So that's about Reddington Pharma. Strides Pharma tumbled. That's about Reddington. Strides Pharma tumbled about 7%. The company's loss narrowed to 7 crore versus 130 crore in the same quarter of last year. Margins at 18% are also a big improvement on a yearly basis. But the revenue has come in 1% lower than the first quarter of last fiscal. The stock ended down 7%. Iqta's here with the details.
Well, the company reported a flat revenue this quarter, but margins improved to multi-quarter highs of around 18%. Besides a flat revenue performance, the street also wanted clarity on the restructuring the company has announced. The company is looking to combine the CDMO interests of the group, which means consolidating the promoter-run injectable CDMO business under Strides into one platform. Stelis, which is the biopharma arm of the CDMO business, will house the additional group businesses. All the CDMO businesses which are proposed to be bought into the new venture are profitable as per the company. The idea the company has said is to make it a specialty-focused pharma CDMO business. These new additions of the business can add around $100 million of incremental CDMO revenue to Strides as per the company. The board has given in-principle agreement and due diligence will need to take place. Scheme details are likely in the next 12 weeks. On the fundamentals, the company expects margins to probably hit 20%, expects debt to reduce by around 700 crores, more than the targeted 500 crores earlier, and they expect US revenues to recover to around $60 million quarterly run rate. While the guidance was positive, the street will seek out more details on the company's restructuring plan in the next few weeks.
Thank you. Let's get to the fifth headline then. Tata Chemicals lost 3% after it cut domestic soda ash prices by 1,800 rupees per tonne. Centrum Broking believes the domestic price revision will impact margins. Sonal joins in with the details.
Thank you for that. Well, Tata Chemicals, of course, is lower in trade after cutting their domestic soda ash prices. Now, remember that domestic business is around 20% of their overall EBITDA as well. And this is a sharp cut, around 5.5% is the cut that we've seen versus June prices. The prices have been cut by 1,800 rupees per tonne. And in last few months itself, the company has cut soda ash prices by 17%. And this is coming after a big rise that we saw in soda ash prices, especially during the COVID period. Now, the reasons for cut could possibly be improved availability of soda ash in the global markets. The supply has increased. There's stable domestic demand as well, and also because of raw material prices falling down for the company. Chinese domestic soda ash prices have also corrected from around $350 to around $250 now. So there's a global cut in soda ash prices as well. Centrum says that they believe domestic soda ash price revision will impact margins, but they will normalize in coming quarters. But yes, it is an expectation that Q1 and Q2 could see some margin pressure on the domestic business of Tata Chemicals because of this reason.
Thank you. And in more stock-specific news, the promoters of Vedanta are planning to sell more than 4% stake in the company through a block deal tomorrow. CNBC Awaaz is reporting, citing sources that the promoter entity, Twin Star, will pay a stake at a floor price of just over 258 rupees per share. This is at a 5% discount to the current market price. The promoters, with this 4% stake sale, are hoping to raise $500 million, which will amount to more than 4,100 crore rupees. And before we wrap, Indigo's parent company, Interglobe Aviation, has reported a stellar Q1. The airline has posted record quarterly revenues of 16,600 crore rupees, a 30% growth compared to the same quarter last year. Profits too have come in at more than 3,000 crore rupees, a fresh record. Fuel costs have dropped 7% and capacity has gone up by nearly 19% in the first quarter. Well, with that, it's a wrap on this edition of Markets Today. Thank you for watching.